It's good to be here, Sarah.
So in reaction to the latest set of rules, which affect you and all the other Fed presidents and Fed governors, do you think it's fair?
Well, fair is not really the standard. I think the standard here is that we need to make sure that we do all we can to preserve and retain the public's trust. Over the last year and a half, we've done as a body things that we'd never done before, unprecedented interventions in the market to try to make sure that our economy got through this COVID crisis with as little damage as possible. But the rules didn't change. And so I think this is a step to reflect and acknowledge that the conditions have changed, our position in the market has changed, and we then need to change our approach to make sure that the public trust is kept.
How do you think about the impact, if any, and potential harm and damage done as a result of this controversy that has unfolded?
Well, I'm hopeful that there hasn't been much damage done. My goal and my approach in my interactions with the public as I try to go about my mission has really been quite positive, even in the midst of all of this. I'm hopeful that swift action will allow us to put this behind us and get us back focused on the job at hand, which is to make sure that our economy continues to grow and that we achieve the dual mandate of stable prices and maximum employment.
I guess whether or not damage has been done or trust has been lost, has this step been taken too late? Should it have been taken not really just months ago, but perhaps years ago?
Well, I think the historians will have to answer that question. Personally, I think these are always hard things to do. In previous lives, I've been involved in regulatory discussions where there have been questions about how far should you change rules or how should you adjust things. And those calibrations are always difficult to assess in real time. I think that the urgency of this change really has emerged because of the things that we did during the crisis. So I'll let that debate happen in another place. I'm just glad that we have taken a step, and I will continue to do my best to make sure that people have trust in what we're doing and really believe that we are all here doing these jobs to advance the public interest and to make this country and this economy as strong as possible.
Just the last question on this, because I know we want to move on to lots of other topics, but I don't know that it's fair to frame this issue as only arising because of the steps you took in the pandemic. The Fed has always had an extraordinary power over markets, and that has existed for many, many years now. And one just wonders whether you should have been, as a group, more forward-thinking about that in a world that evolves and wants to make sure conflicts of interest were removed. It feels like that's a bit of an excuse to hide behind, as opposed to owning up that a mistake was made, we've made a change, we should have made it earlier.
So I'm not going to get into a debate with you on that here. I will say that once the issue was acknowledged, what we did was act. And I think that that's kind of all that we can speak to at this point. And we can have lots of debates about when was the best or appropriate time to do it. But that's behind us now, and I'm going to try to stay focused on the job at hand moving forward, taking these rules into account, and making sure that we don't trip on this again in the future.
So let's talk about the task at hand. One thing I loved reading was when you talked about I don't even want to say it because I don't want to get fined.
I was hoping you were going to say it. I could get $1 out of this.
So I love that you have a swear jar for the word T. I'm not going to say it. But it went from being so overused from the Fed chair, all the Fed members, to now you really don't hear much of it. So how has we won't use a word to label it, but how do you think of how long and how damaging and dangerous this inflationary period is going to be?
Well, one of the things that we've seen, and I've heard from business leaders across the 6th District where I have my jurisdiction, is that the disruptions are going to last longer than we expected. The labor markets are not going to get to a new equilibrium as quickly as we had hoped. And but demand was also going to stay high. And that combination was going to mean we're going to have inflationary pressures. And the more I talk to folks, it's becoming clearer and clearer that this is going to last into 2022. Part of what the ultimate answer to how long this will take will be how quickly we resolve some of the the coronavirus issues, as well as some of the supply chain challenges that are happening at a global level. In terms of how damaging this is, I do think that this is something that we're going to monitor very closely, and we have a number of surveys to get a sense of whether businesses have changed their strategies and approaches to production and pricing, and whether consumers are changing the things that they're buying and how they're investing in themselves to get skills that will allow our economy to be even more productive. Right now, we're not seeing signs that there has been that kind of damage and those sort of changes in terms of behavior, but I'm going to keep watching it very closely. And if I do, I will really encourage my colleagues and I to take some definitive steps to try to prevent that damage from getting very deep.